If you are wondering whether Houston has finally become a buyer's market in 2026, the data points to a resounding yes. The financial pressure that has kept the market frozen for years has finally broken. For the past few years, anyone trying to buy a house here felt trapped. We were stuck in a landscape pinned down by high interest rates and low housing inventory. The music had stopped. Homeowners stayed in their properties, unwilling to let go of low rates. That paralysis ended when mortgage rates retreated from their 8% peak. Once rates hit the 6.3% mark, the math of monthly affordability started to work again, releasing years of pent-up demand. We have seen volatile markets like Austin experience wild swings, where median home prices skyrocketed past $500,000 and then sharply contracted. The Houston metro, by contrast, has held its ground. It operates as a model of steady resilience, avoiding the boom and bust cycle of its neighbors. A single percentage point drop in mortgage rates qualifies roughly 5.5 million more households nationwide. This trigger instantly returns leverage to the homebuyer. We can see this leverage in the data. Look at Houston's active listings. Inventory has expanded, reaching a healthy 5.1-month supply. As inventory climbs, the time it takes to sell a home is stretching out too. Days on market has pushed up to 54 days. For buyers, that extra time translates into breathing room. The frantic weekends of waiving your inspection and blind bidding way over asking price are mostly behind us. Do not mistake a slower pace for a dead market. While closed single-family home sales softened slightly over the past year, newly signed purchase contracts, pending sales, climbed nearly 6% to hit a 4-year high. Despite this shift in power and expanding inventory, the median single-family home price in Houston held perfectly flat at $340,000. When inventory grows and prices hold their ground, it proves the market is normalizing. It protects the equity of current homeowners while finally opening the door for new buyers. With more homes sitting on the market longer, individual sellers and massive corporate home builders suddenly find themselves fighting over the exact same pool of buyers. To win that fight, they are offering seller concessions. Instead of knocking $10,000 off the list price, sellers are paying upfront fees to lower your interest rate for the first few years, known as a 2-1 buydown, or covering 3% of your closing costs. Nowhere is this more evident than in Northwest Houston. Master-planned communities like Bridgeland have become the epicenter for these aggressive new construction incentives. Navigating these suburban developments requires reading the fine print. You have to account for municipal utility district, or MUD taxes, which fund local infrastructure. This chart shows the steady, unbroken upward trend of total non-farm employment in the Houston metro area through 2025. For investors, this job growth proves the resilience of Houston's economy, making it a reliable bet for long-term holds. High-yield strategies are targeting 2 specific areas right now: the luxury market for homes priced over $1 million, and strategic rental properties positioned near expanding economic hubs like the Texas Medical Center. As for sellers, the reality is stark. If you rely on 2022 pricing strategies, skimp on your staging, or refuse to negotiate concessions, your property will sit on the market. With expanding inventory, stable prices, and falling rates, June 2026 is the year of the buyer. This balanced window of opportunity rewards those who adapt their strategies to the current environment. General data provides the framework, but winning in this market requires neighborhood-level updates. Subscribe to the channel for future insights, and reach out to a local expert to build your specific 2026 real estate strategy.